guess what? I heard that NVIDIA stock went up a lot. And you know what that means for retail moron clowns? Boy. But what you're missing is that I am actually going to 10x my index. Welcome back to Strongman Personal Finance. We got to talk about Disney stock. Why? Because I got paid to do it. This is my last paid video. I'm actually out of videos after this. But if you want a personal dedicated paid video, click that link, send me $50 and I'll make a video. We're going to talk about Disney stock because Disney is very popular. It's Disney, bro. Who hasn't heard of Disney? Massive moat. It's Disney. Of course it's going to go up, right? The stock is going to 10x because it's down recently. Now, let's go ahead and check out the financial statements. So here's the Walt Disney Company. I'm going to diss you, bro. I'm going to diss you. What is Disney? The Walt Disney Company operates as an entertainment company worldwide. It operates in two segments, Disney Media and Entertainment Distribution and the Disney Parks. Let me tell you how I feel about the Disney Parks. Me and my spouse are both massively anti-Disney. As a matter of fact, I might never take my kids to Disney because it is an outright scam, okay? Disney is a ripoff. But here's the crazy thing. The reason it's such a ripoff is because there are fanatical lovers of Disney. You know those like weird adults? I wear Mickey Mouse ears and I'm a weirdo. They go to Disney and they'll pay whatever price they have to pay to get into the park so they can see Cinderella. Those people are what make Disney's moat unbreachable. Disney is a Chad, okay? But it's also a scam. At least the parks are. But that's basically the business. It's the media segment, obviously all the Disney movies, all the companies they own, which is they're surprising the companies that they own. I didn't know a lot of the stuff when I was reading about it. They have the media section and they have the parks. Those are the two main segments of the business, okay? So if you want to read more about the business, I always like to pull up the 10K. But actually, before we do that, let's go ahead and look at an overview of the financials. So the stock was trading at 144 before the pandemic, right? So people are looking at this and they're like, okay, before the clown market, this stock was in the 130s and 140s, 120s, whatever. You know, it was getting pretty up there. And then obviously the lockdowns happened, the parks were shut down, revenue and profits plummeted massively, but the stock still went up because Disney and then a bunch of clowns bought it up here. And now the stock has absolutely collapsed. And the question is why? It's Disney, bro. I mean, the stock price was 137, 140 before the pandemic. Why won't it recover? Well, let's see what could have happened. And my suspicion is they packed on a lot of debt. That's right. So, market cap of 161 billion, revenue of 86 billion, trailing 12 months profit of 4 billion, and shares outstanding of 1.3 billion. And analysts say it's a strong buy. And they have an earnings date of May 10th. Oh, I actually pulled that up because I'm so good. I already have that pulled up. So let's go ahead and look at the revenue my avenue. What is Disney's revenue my avenue? Well, it's been consistently going up. And as a matter of fact, after the pandemic, it's continued to grow. It was almost like growing at a slower rate before the pandemic. But we can see that they still have steady, continual revenue growth. What about the profit margins? Let's see. Gross margin looks to be trending down. That's interesting. Profit margin, massively trending down. So when you're looking at Disney, right, and you look at it before the pandemic, and you're like, oh, well, the stock was so high before the pandemic, and now margins are down. Yeah, there's actually a reason why the stock price is lower than it was before the pandemic. Okay, margins are down. And I wonder how much interest expense has to do with that. Okay, and then we have profit margin. Now, the only difference between operating margin and profit margin is interest and taxes. Okay, so if you see a broader disparity coming between those two, it's probably interest, unless there's a tax raise, which there wasn't. So I have a suspicion Disney is paying a lot of interest, but we'll see. Okay, look at even free cash flows down. Okay, so all their revenue is still growing at a healthy clip, but their margins are down. So before the pandemic, it was probably priced into the stock that they would grow revenue at a certain percentage, but with higher margins. Now that I think people are pricing in growth of revenue, with lower margins, which leads to lower stock price. Okay. In general, let's look at shares outstanding. What happened here? Okay. We had some shares issued in 2019 and it looks before the pandemic. That's interesting. So it looks like they had a pretty significant share issuance in, what is that? The middle of 2019, the third quarter of 2019, it looks like. I guess we'll see why in a little bit. Okay. So overall, shares have gone up, but they haven't gone up much since the pandemic. So that definitely tells me they put on a lot of debt. Balance sheet, we'll skip that for now because this thing sucks for balance sheets. Let's look at operating cash flow. Operating cash flow is on average much lower than it was before the pandemic. And on top of that, they actually had a pretty bad quarter at the end of 2022. That's interesting. Now, here's the thing with Disney, right? I have a suspicion. I mean, I could be completely full of crap. I hear a lot of people when they file their taxes, they get their massive tax credit because they have children. And instead of putting it into their Roth IRAs, instead of putting it into their 401ks, they go to the parks and they spend it at the freaking parks. So I'm wondering if some of the companies like revenue fluctuations, where they probably have a spike, is probably due to people going to the parks in the first or second quarter of 2023 or of each year. So that's my suspicion there. Because a lot of people, they will take their entire tax refund and they will go to Disney. So I suspect there may be a boost in park visitations in the first and second quarter. I could be totally wrong, but that's my suspicion. But anyway, operating cash flow is worse than it's ever been, or at least from what I can see here. Okay. Let's see. Capital expenditures are roughly the same. Okay. They're still doing the same amount of investments. Acquisitions. The last acquisition was in Q1 of 2018. Change in investments, that doesn't really matter. Okay, dividends paid. What happened? What happened to the dividends? There's no dividends. What? This company's worthless. Sell. So apparently they suspended their dividend in the first quarter of 2022. Wow, what a shock. Share issuance. Like I said, we didn't really see any share issuance. Debt issued and paid. What's going on here? So it looks like they packed on a ton of debt, probably for their acquisition in the first quarter of 2018. And then they packed on more debt, a lot of debt, in the first and second quarters of 2020. That's crazy. Why did that happen? That's interesting. Okay, so obviously they packed on a ton of debt. Now, let's go and look at the ratios, bro. What's the PE? That's all that matters is the PE. Oh, the PE is low. Okay, that's good. It's lower than it was. Price to sales is lower than it's ever been. Oh, maybe because it's less profitable. No way. Price to books ratio is lower. Okay, I guess it's cheap, right? Debt to equity ratio, let's see. They're actually paying off debt, it looks like, pretty decently. Okay, that's good. Well, yeah, because you see the spike in the debt to equity ratio when looks like they took out a huge loan to make an acquisition. And then obviously it spiked again during the pandemic, and now they're coming. So they're paying off debt. Okay. So overall, decent revenue growth, paying off debt, but margins have compressed. Okay. Probably because of interest. Now let's go ahead and read more about the company, because I saw some interesting. I was actually skimming this before because I've never really looked into Disney. I mean, obviously I know what Disney is. Okay. They have theme parks and they have a bunch of movies and stuff, right? Well, it's actually interesting, what businesses are actually owned and controlled by Disney and being entertainment. Remember, there's two main segments. There's the parks, and then there's the media arm of the business. Okay, look what Disney owns: ABC, ESPN, Fox, not Fox News, but the other Fox, National Geographic, A&E. Holy crap, I didn't know they owned all that. That's crazy. I was reading this. I was like, wow, that's the more you know. Okay. You learn so much by reading 10Ks. It's crazy. They have direct to consumer, which is Disney Plus, the future, bro. And then we have content sales and licensing. Basically they make a bunch of money by going directly to consumers with Disney Plus, or they work with intermediaries, that actually conglomerate a bunch of different shows together, like Verizon, blah, blah, blah. They work with them and they get paid by those companies to have Disney shows be played on their platforms. So that's the main part of that business. And obviously, there's a little bit of advertising going into this. So you're going to see some fluctuations because advertising always pays the most in the fourth quarter of every year. But Disney's a big operation, okay? And it's a much bigger operation than I ever imagined it was, okay? I thought it was, it's Disney Plus and then some parks. No, it's like ESPN of all. So that's the business, okay? I mean, I know brief overview, but I'm not going to explain every freaking detail. Let's go ahead and look at the risk factors. We got some risk factors, right? Always read the risks. Let's see. Parks and experiences. Blah, blah. Okay, that's just explaining more of the business. Tokyo cruises. Wow, look at all this. Okay. The adverse impact of COVID-19 on our business will continue for an unknown length of time and may continue to impact certain of our key sources of revenue. Oh my God, there's so much junk in here. Do I even want to read that? No. Changes in U.S. global economic conditions, changes in technology, misalignment with public tastes. Okay, these are very generic risk factors, okay? But, I mean, I'm not worried about Disney losing relevance. I would be shocked if Mickey Mouse was no longer popular, okay? If Mickey Mouse hasn't been slain now, he's never going to get slain, okay, except by Minnie Mouse. Increased competitive pressures may reduce our revenues. Results. Okay, so there's a lot of generic crap on here. Okay, let's see what else they have on here. I like to read after that management's discussion and analysis. So let's go ahead and look there, see if we can find anything interesting. Management's discussion and analysis. And remember, this is the financial statements as of December 31st, 2022. So we're going to look at the most recent earnings, but if you want like more detailed reports, you want to look under the 10Ks, and hopefully it's decently recent, okay? So, okay, obviously they have revenue. I want to see if there's any discussion here. Leadership change and pending restructuring. As previously announced, Robert A. Iger returned to the company as CEO, as a director. Mr. Iger previously spent more than 4 decades at the company, including 15 years as CEO. He's going to fix that. He's going to right the ship, okay? Let's see. Consolidated results, segment reporting, costs and expenses. I'm trying to see if there's anything interesting on here, and then we'll go to the most recent earnings, okay? Nothing there. Okay, let's go ahead and check out the most recent quarterly report. So obviously you want to look at the most recent stuff. What's going on with Disney? The Walt Disney today reported earnings for its second quarter ended April 1st, 2020. Revenues were up 13 and 10%. They do have good revenue growth. I mean, we saw that, but it's the profits that are down. Diluted earnings per share increased to 69 from 26. Blah, 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 blah. EPS increased, blah, 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 blah. Okay, so their profits are coming back a little bit, obviously. Okay, let's look at the revenues. Revenues are up 13% on the quarter. Income from continuing operations is up 93%. Okay, so their income is basically their profits are catching up to where they were before the pandemic, or they're catching up, basically. They have a much faster growth in profits, probably because they were losing money hand over fist. Okay, free cash flow. Okay, so they're starting to recover, but the question is, will they get back to the margins they were before? I don't think so until they pay off their debt. Let's look at the segment results, okay? Income from continuing operations. Let's see. Okay. Segment revenues year over. Disney Media and Entertainment Distribution. So Disney's media and entertainment distribution is only up 3% year over year. Okay. Wouldn't you think that like Disney Plus was like the big thing that's supposed to like massively grow their revenues? It's up 3% year over year. What is up massively are the parks, experiences, and products. That's interesting. And yeah, the parks are a grift. Okay. I heard they massively raise prices at those parks. It's such a scam. Oh, but it's the Mickey Mouse. So, revenue for Disney Media is clownishly low. It's growing very slowly. The parks are basically carrying all the weight right there, at least when it comes to revenue growth percentages. And total revenue grew 8%. Total segment revenues grew 8%. Now, let's look at the operating income. So, revenue for media grew anemically, and operating income, while still positive, collapsed. Okay, it's down 42%. While the Disney parks operating income went up 23%. So the Disney parks are basically just carrying Disney on their shoulders. Okay. Wow. That's pretty sad. And if you look at for the 6 months ended April 1st, 2023, their operating income is down 60% for media. So the media just sucks. Okay. Let's look at this specifically. Why media went down. Let's see. Linear networks. This is like ABC and ESPN, all that garbage. It's down 7%. Direct to consumer Disney Plus. So Disney Plus is doing well. Content sales, licensing is up. Elimination of inter-segment revenues. That's funny. So in accounting, when you have two different parts of a controlled business, of a controlled operation. Let's say we have Strongman LLC, Strongman CPA LLC, and Strongman CPA LLC controls two other LLCs. Well, if you were to consolidate those statements, if those two LLCs were selling between each other, those are fake profits. Those don't exist. Okay. So when you consolidate an entity into one to present it financially as one entity, which Disney's doing, you have to eliminate inter-segment revenues because they're fake revenues. So you look at this, and that's a huge difference there. So, look at our revenue. And then they eliminate a huge part of the inter-segment revenues. Well, it's not a huge part of it, but there are some eliminations going there. So overall, basically the old legacy ABC, NBC, all those things have gone down year over year. But Disney Plus and et cetera, has gone up 12%. And then content sales, licensing, and other has gone up 18%. So linear networks, the legacy dragged Disney down, at least for that segment of their business. So overall, it's like, I guess if you're like bullish on Disney Plus and direct to consumer, okay, not horrible. And the profits, linear network profits, okay. It's basically the linear networks are what's screwing it, which, like I said, if you're bullish on Disney Plus, direct to consumer, this isn't like bad to see, okay? But Disney Plus and all that isn't even profitable yet. It's still losing money. That's funny. Let's see. Content sales and licensing. Man, that makes almost, look at that. It makes like no money. Content sales and licensing. They're barely making money on that. All of their money comes, all their profits come from linear networks. And that's the one that's collapsing the most. Okay. Linear networks. Let's see what really screwed them over. Supplemental revenue. Domestic channels down 4%. International down 18%. Probably a big part of that is due to currency. Supplemental operating income, domestic. Yeah, the whole that whole linear network thing is just collapsing. Okay, it's garbage. Let's see. The decrease of cable was due to higher sports programming and production costs, and to a lesser extent, lower affiliate and advertising revenue. Okay. International channels dropped 18%, primarily due to lower advertising revenue, partially offset by a decrease in costs. Okay, so they don't really say currency there. That's interesting. Okay, hold on a second. Excuse me. Okay, so now we're talking about direct to consumer, Disney Plus and ESPN Plus. I didn't even know that existed. ESPN Plus. The decrease in operating loss was due to improved results. The improvement of Disney Plus was due to higher subscription revenue and a decrease in marketing costs, partially offset by higher programming and production costs. Higher subscription revenue was attributable to subscriber growth, and I wonder how much the subscribers grew. Improved results at ESPN Plus were attributable to the growth in subscription revenue due to an increase in retail pricing and subscriber growth. Okay. Did they say how much subscribers? Okay, here we go. The following tables presented about our Disney Plus, ESPN, and Hulu direct-to-consumer. Do they own Hulu too? I didn't know that. Man, look at this. Let's see what you learned from this. So let's see. Paid subscribers. Okay. This growth is trash. Look at it. What is this? Look at the subscriber counts from December 31st to April 1st. So the revenue's gone up, so I guess they're charging more they're charging the subscribers more. But look at the growth. That's trash. Okay? I don't know if this is like a cyclical thing, maybe, but from December 31st, 2022 to April 1st, 2023, Disney Plus's subscriber growth is not that great. Okay? What, negative 1% in the course of 3 months? Okay. But you know what did go up? Sports ball. Sports ball is doing really good. Sports ball. And then Hulu, flat, basically, like your mom. No, I'm just kidding. Revenue per subscriber. So the only reason they're making more money, Disney Plus and ESPN, or more revenue at least, is because they are charging more per subscriber, or they are receiving more revenue from whatever sources per subscriber. But the actual headcount growth is not that good, at least recently. Okay. See how much you can learn from this? This is interesting stuff. Okay. Wow. Disney parks. Okay, let's read about the parks. Oh, people are getting scammed.
If you don't take your kids to Disney, you're a horrible parent, and your kids will be depressed and fail at life because you didn't go and spend all your tax refund that you could have used to pay off debt or invest. Instead, you decided to not go to Disney. You loser.
What a freaking joke. Okay. Disney parks experience is up 17%. Higher operating results. Blah, 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 blah. Let me see the numbers. Okay. Domestic parks. The following table represents supplemental revenue operating income detail for the Disney parks. Supplemental revenue detail. Parks and experiences. 14% domestic. Over 100% international. Boom, 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 boom. International. Yeah. So international revenue growth has been massive, but I don't foresee 10% or 100% every single year continuing. But hey, man, that's pretty good. Even for domestic, it's up 14%. Like that's not something to shake a stick at. Okay. Profits are up. Do they have like a nice calculation there? So domestic parks profits are up 10%. Operating income. International went from a loss to a positive. And consumer products has actually gone down. So overall, the parks are doing well, but this is probably a one-time recovery thing that you're not going to see 100%, I don't think, going forward of year-over-year growth in international park revenues. But even the domestic, like that's obviously beating inflation. That's pretty good, okay? In the current quarter, the company recorded charges for severance, reduced charge, impairment of a Disney Channel in Russia. That's funny. Okay. Interest expense. Here we go. Interest expense is actually getting worse. Okay, that's not a surprise. And interest income is also going up. So the net interest expense actually went down because they're generating lots of investment and interest income. That's great. Okay, let's go look at the equity income and investees. Now, what does this mean? When Disney buys another company but does not control it, but it has significant influence, the profits of the company that they partially own get reflected in Disney's income statement. Let's say Disney buys Strongman CPA LLC, and they own 30% of my business. They have influence in my business, but they don't control me. I own 70%, they own 30%, right? 30% of my business's of Strongman CPA's profits show up on Disney's income statement. That's basically what equity and income of investees mean, okay? So this is companies that they don't control, but they have some kind of significant influence and ownership of. So, okay, it went down. Equity income, and it's still positive, but it went down. So whatever they own. Okay, so they don't, looks like they don't totally control A&E television networks. Interesting. All right, let's go look at the financials. I'm tired of reading all this crap. Well, here's cash flow. Operating cash flow is up. Investments are up. Cool. Free cash flow still negative, but narrowing down. Okay, let's look at the financials. I'm getting bored of all these words. I don't like reading. I just like looking at numbers.
Okay, let's look at the profits and losses for April 1st, 2023.
Revenues are up. Costs and expenses are also up. Let's see, restructuring and impairment charges, nothing significant there. Other income or expense, interesting. Interest expense, wonder how the interest expense has changed over time. Let's see how much they're paying in interest versus historically. Interest expense. Where are you? There we go. Look at that.
Woo, baby.
That's probably why their margins are down. Interest expense. So overall, well, they have more income from continuing operations. Interest. So basically, they're just paying more in interest expense. Okay, overall, at least from before the pandemic. Let's see. Net income, earnings per share. Yeah, I mean, nothing crazy on here. I want to look at the balance sheet. That's what interests me more. Okay, this is a comparative balance sheet for October 1st, 2022 to April 1st, 2023. So this is the most recent one. This is 6 months ago. 6 months? Okay. Cash, roughly the same. Receivables are the same. Inventories, nothing crazy with current assets. So they have current assets of $28 billion, excuse me. And they have current liabilities of $28 billion. Are they about to go bankrupt? No. A big part of their current debts are deferred revenue. Okay, so current assets seem okay. Product and license, produce and license content costs. It looks like these are probably amortized over time. Up a little bit. Investments up a little bit. Nothing crazy. Property, plant, and equipment. They made some investments in that, obviously. Projects in progress and land. So I like how they break that out. That's nice. You don't depreciate land, clowns. And you don't depreciate projects in progress. But once they finished and they start being used, then they get depreciated and they hit the income statement. So overall, their total property, plant, and equipment is $34 billion, of which 28 is actually in use. Intangible assets, goodwill. They had a tiny impairment, it looks like. It could be a foreign currency thing too. And so overall, like their assets really haven't budged. There's no like major massive changes that I see under the assets. I mean, it seems okay. Current debts. Okay, nothing really crazy with current liabilities. Borrowings. Borrowings is flat. What was that before the pandemic? Let's see. Yeah, because this isn't going to show. I wonder if this one would show it better, how much debt they packed on. Probably not. We probably have to go back further in their financials to see how much debt they packed on from the pandemic. Yeah, let's go to the balance sheet here. Long-term debt. Yeah, look at now this is why their profits are probably down a little bit. They're recovering from the pandemic and they have way more debt. Look at that explosion in debt. Okay, they had some kind of acquisition and then they had to pack on even more debt because of the pandemic. Woo, baby. All right, let's keep going. Stunk, nothing crazy. Yeah, I mean, there's nothing crazy on here. Obviously, the main thing with Disney, I think, is just they have a lot of long-term debt that they didn't have, just a couple years ago, which affects profits. But I don't see any like imminent bankruptcy, disaster things going on here. So let's see. Let's look at the statement of cash flows. Operating cash flow is up. And a big part of that difference is because they are subtracting out accounts payable and other liabilities. So basically, they have a bunch of accrued expenses that they haven't paid yet. So that's a big difference with operating. A lot of the times, it's a timing difference. Actually, let's see. Did I flip that over? Accounts payable. Okay, no, so they actually paid off. So even with paying off accounts payable, they actually had more cash flow. So ignore what I said. Let me see why there's a difference here. See if there's anything else that stands out to me. No, I think it's just more. They're generating more cash flow just from continuing operations. I don't see any like major discrepancies that would explain why their cash from operations is up. Sometimes, like I said, sometimes it's a timing issue, but I think they're just making more money, generating more profits from their parks. All right, investing, whatever. I don't see anything crazy here. Commercial paper borrowings. Okay, they're paying off debt. Sale of non-controlling interest. Acquisition of redeemable non-controlling interest. Wonder what that was. Other. I mean, looking at this overall, you know, it could go back to where it was before. Okay. It 100% could, but they got to pay off that debt. And it looks like they're not really paying it off super fast. Okay. Disney has way more debt than it ever has historically. They had some kind of acquisition before the pandemic that racketed up their debt. And then the pandemic happened, which is unexpected. And then that ratcheted the debt even higher. And it's going to be a huge pain in the butt for Disney to get rid of that. But there are some encouraging signs. You know, park revenues coming back stronger than ever. Disney Plus is doing well, at least so far. Legacy, all their not direct to consumer, but like their affiliates and all that, that's been going down, but it's still the lion's share of their revenue. So I don't know. Is this going to 10x? I don't know. I'm just not a fan of Disney. I don't know. I like China stocks. Those will 10x, not this garbage. That's kind of my thoughts. All right, let's do some comments. Holy crap. I'm actually getting a lot of views on this video. Most of my paid videos bomb. Effing clown is live. You didn't know NVIDIA was going to 10x, you stupid. Hello. What's up, bro? Disney. Anyone buying? I see you delaying the Baba Shill video because the stock went down, bro. Yeah, that's right. It's not because I have a bunch of people paying me money. Let's see. Buy Tattooed Chef. Universal is better anyway. They just need to increase prices to improve. I don't know how much they could do that, man. I don't know. There's a certain point where people are like, I'm not paying for this. They own a cruise line too. Disney is a big business. I was reading that because I really have done like zero research into Disney, but I was reading that a little bit beforehand. I was like, man, they own ESPN? ABC? What? This is crazy. Disney has too many components to the business, already $150 billion. It is a very hard company to analyze. Like, you have to like understand there's a lot of details that are going on. It is not a simple business. I can tell you that. Wow, Netflix is actually bigger than Disney. Yeah. All in NVIDIA, bro. Although I am into index funds, the only individual stocks I own are NVIDIA and Apple. Of course. I bought NVIDIA at 20 holding long term. What is NVIDIA now? How much profit are you sitting on, dude? Man, I mean, I'm not going to tell you what to do, but I know what I would do if I bought NVIDIA at 120. Oh, my God. They need to mention AI, ChatGPT, AI. How much do you really expect NVIDIA to grow from a 1 trillion market cap? Okay, let me say something about this. I'll make a separate video because now I'm finally done with my paid videos. Unless somebody pays me again. Which, by the way, if you want to pay me money, you click that link, you send me $50, I'll make you a dedicated video. Anyway, let's go back to that comment. We're in a new clown market, a small clown market, where now instead of electric cars, now it's AI. And Tesla's still participating in it because it's like Tesla's still like involved in AI. And Elon Musk is actually a genius. You don't know why? Because he probably knew the next clownish bubble was going to be AI. So what he did is he creates this clownish robot. I am Optimus Pussy. And he's like, well, see, I'm into AI too. So you should buy Tesla stock because you see, I have 2 Optimuses in my whole business. Yeah. He's moving on to the next scam. EVs are old news, bro. Now it's AI, ChatGPT. AI is in the report. Of course it is. I'd rather own Spy over Disney. Me too. Me too. Disney adds grist for retail. Shouldn't have the potential to beat the S&P by much. If anything, Disney, yeah. Even if it does, who cares? You can't pick them all. Why would I buy Disney trading at a 5-year low when I can go on NVIDIA at all-time highs? Well, Disney is trading lower for a reason. They definitely are. That's because their margins are lower. Let's see. For every sector that Disney grows, yeah, I was pretty surprised. Their legacy, their legacy media component isn't doing too hot. It's the Disney Plus that's growing the fastest. You have to be bullish on that because the majority of their legacy of revenues come from legacy, where they're not going direct to consumer, and that's not doing too hot. So there's going to be a long transition period there. NVIDIA's, oh my God. See, now NVIDIA, I hate this, man.
NVIDIA, what up, bro? Buy it.
Meet Tesla was talking about this being, of course he was. Or Disney or NVIDIA? Kevin, I'm coming for that butt if you're talking about NVIDIA. Will NVIDIA 50 to 450? Takes kids to Gold's Gym instead of Disney. I am not taking my kids. It is such, you're being scammed and everybody knows it. Okay. I cannot enjoy myself when I'm being actively scammed. It's like going to an expensive steakhouse, right? You can go to Outback and get a great steak. Perfect steak. Or you can go to this really nice steakhouse and pay 5 times the amount for the same freaking steak. You are getting scammed. And when I do that, I know I'm getting scammed, and it freaking infuriates me. I can't enjoy myself when I'm getting scammed. And if I went to Disney, I know I would be pissed. You know where you can go in Florida? Gatorland. Okay, that's not a scam. You get to see alligators. It's like $30 or whatever. Disney. What a scam. Mickey Mouse. Princesses. Frozen. Let's see. Stock Mo loved this. Stock Stink Blow. Jeremy finally sold Tattoo Chip. What a loser. I hope it goes back up now. Let's see. Isn't Ron DeSantis kicking Disney out of Swamp, Florida, and North Carolina? Sales! Yeah, I don't think he would actually do that. But, we'll see. I don't really care. I love Strongman Personal Finance. He's so hot and amazing. Let's see. Outback, great. What's wrong with Outback? Come on, man. There's an example. Last year, my value stocks killed it. This year, I'm getting my cheeks clapped by not owning bubble AIs. You know what's funny about that? There's this ETF called VT, right? Where you own all of them and you don't have to time the market. It's crazy. You know all the AI stocks that are mooning? I've owned those for a decade. I have technically bought NVIDIA at its bottom, power bottom. And now I'm up massively on my NVIDIA purchases through VT. It's crazy what an index can do. You don't have to time the market. I used to wrestle alligators. I'm sure you did. If my parents took me to Gatorland instead of Disney, I'd have serious regrets. Dude, Disney is not, it's not that great. It's a scam. Okay. And there's other things you can do besides go to Disney. You can go travel the freaking world. You could do multiple vacations. You could take your kids to, go see, just tour the South. You could go to the Northeast. You could fly them to California, or you could go so many other places and give people good experiences that aren't getting scammed at Disney. Okay? Massive scam. VT is a scam. Yes, VT is a scam. All right, guys. Well, that's my hot 10x stock analysis on Disney. Pay me money. Otherwise, I'm going to be doing my own videos now because I'm out of paid videos. No, my money's drying up. What am I going to do? What's my next grift? All right, talk to you later. Cheers.